Well, welcome here to the last class in which we're going to be covering new material. And specifically, what we'll be covering will be just some odds and ends topics there toward the end of the syllabus. And we started the other day with special reports in our last session. So that's where I'm going to be picking up today. So, what am I talking about here with special reports? Go ahead and pull that up on the screen. All right, if you're online, what I'm going to do is share my screen. I'll show you where I get my Canvas file. I'm going to go here to our Canvas website, our files, AU-C 806. Well, various, I should say various pronouncements here. Most of the material comes from AU 806. All right. So, for those of you in class, I don't know whether it will work on, but whether the projectors here today will work, but I'll go ahead and give them a try while I'm at it. Oh my goodness. Well, I just plugged it in here in class and, well, looks like the projectors are working today. Of course they would. I printed out paper copies for everybody in class. Geez, I don't know why it was doing different. Differently, pardon me. All right. So, yeah. Well, what we done the other day, we've gone through most of this, and we were just down to a type of special report here at reports on the application of accounting principles. And here in class, oh, I don't know, these projectors aren't doing too well. They're flashing on and off. Do you think they're going to stay on? Is it annoying having, pardon? Yeah, I can read between the flashes, huh? Oh, Lord. So, reports on the application of accounting principles. Now, this is going to be kind of a weird pronouncement. It's sometimes called the shopping around SAS, statement of standards, statements of auditing standards. Well, the reason it's sometimes called that is because sometimes potential clients will shop around, like at a cocktail party they happen to be at. They shop around for things like medical advice. If you're a physician, if you are an accountant, yes, they shop around for advice from you sometimes. So there are always people out there looking to get some free advice. Well, this pronouncement is going to remind us as to what we should and should not say. So you might see a multiple choice question about on CPA exam, but just want to cover it. It's short, sweet, and simple. That will maybe make the difference between that 74 and 75 on the CPA exam. So let's just see what we have here. What this applies to. Well, first, reports on the application of accounting principles to specified transactions, either complete or proposed specific transactions, those are called. So such as someone comes to you and they say, well, what if I bought this other business? What would my current business's balance sheet then look like? Well, again, they're trying to get free advice. Or second, reports on the type of opinion which may be rendered on a specific entity's financial statements. So here's my business. What kind of audit opinion do you think I might be able to get? Again, they're shopping around. They want that free advice. And then reports on the application of accounting principles, hypothetical transactions for a specific entity. Well, if I bought not a specific business, but just any small business to add to my portfolio, what would things then look like? Again, they're shopping around. So anytime they ask you, what might things look like? Know what's going on. And very importantly, in B, this also applies to oral advice on the science, if it may be used as an important input to a decision by the user. So it's telling us to watch what we say at that cocktail party. Yes, indeed. If there's a cash bar, they might go up there and buy us another drink. They're hoping to win favor, plus they're hoping that we'll kind of loosen up with an additional drink and give them some free advice. So we're going to be really careful what we say, as you'll see in a moment. Now, this does not apply to expert testimony. So if we're testifying in court, sworn testimony, no. Does not apply to advice given to another accountant. So if you're telling another CPA something, no. Does not apply to position papers. For example, if I wrote an article for the Florida CPA Today, the Journal of the Florida Institute of CPAs, and I said in there what my position is on whatever. So what is my opinion on the current audit report? Well, that's position paper. No, it doesn't apply to that. It's only if you're giving it to someone who might use it as advice for their own decision. Now, it's actually a type of engagement, believe it or not. Maybe a simple one, but still, there are some things we should bear in mind. Don't just give advice off the cuff. So with performance engagement, due professional care, adequate technical training and proficiency, and adequate planning and supervision must be employed. Ooh, it's better not to say anything. And the accountant must also understand the nature of the request for the report. Must also understand the form and substance of the transaction. That means if I have to do all those things, maybe I better ask this person for some money to do so. And if you were to ask this person for some money to give them the answers they are wanting, what do you think that person is soon going to do? Go away. Yeah, they're looking for free advice. So that usually solves the problem. And then you say, well, I've got to include these items in the report that we'll see here in Roman numeral 3. A brief description of the nature of the engagement and a statement that was performed in accordance with the ICPA standards. Not GAS. It's not audit. That's why. Description of the transaction, a statement of the relevant facts, circumstances, and assumptions, and a statement about the source of the information. Principles 2, specific transactions should be identified, and hypothetical transactions, bless you, should be described as involving non-specific principles. Then a statement describing the appropriate accounting principles to be applied, or the type of opinion that may be rendered on the entity's financial statements. If appropriate, a description of the reasons for the account's conclusions. Then a statement that the responsibility for the proper accounting treatment rests with the preparers of the financials, who should consult with their advisory, normally their continuing account. So in other words, go back to your regular accountant and get answers. A statement that any difference in the facts, circumstances, or assumptions presented may change the report. So that's just cautioning us to make sure that we are careful about just giving advice in any place. Well, as it turns out, again, this person's probably just going to go away. But it's not a good idea just to give advice any place that someone may see us and ask for it. Any questions there on that short pronouncement? Righty. By the way, this short case here was for the special reports that we saw, and specifically, it's going to be about up here, the first part of this handout. And you'll be fine even if you don't do it, tell you the truth. Just for your own clarification, there's an answer there for it if you'd like to do it. You do not need to submit it any place. It just helps illustrate the material. And that takes care of special reports. So with special reports there, any questions about them? Okay. So those of you in class, let me get another paper handout here for you since I ran them off. Yeah, it's going to be about interim financial information. In fact, let me just go ahead and pull this up. Those of you online, let me share my screen as I pull this up. So I'm going to go back here to files. Let me actually go for this one. By the way, you've got some homework solutions along the way if you would like. Although for this material, even if you didn't do homework, you would still be okay with understanding it. So I'm going to go here for AUC 920, letters for underwriters. So there on, if you're online, you'll see the handout, and let me actually distribute it here in class right now. Let me run back to my office very quickly. I evidently left this one back there. Be right back. very trusting, you know, just leave my wallet up front. I'll tell you what, my ID card's in there. So I had handouts, I came in, I just put it up front there. Tried to unlock my office, it was still in my hand. But yeah, here in Florida Southern, you notice how people just leave things like wallets, purses, computers, wherever. I know. We must have a really honest bunch of people around here, huh? Be right back. There we go. By the way, I didn't know this for a long time. Used to be that when I needed to prop one of these doors open so it wouldn't go locked, I would do something like put an eraser in there. Well, you actually don't have to do that. If you have a post-it note, just put that over the little hole there, and that'll do the trick. Just a post-it note. I've done that for a long time. I found out that Paul Eberly, a finance professor, whom some of you may have known, he retired. He used to have my office, and he had the post note up there ever since we moved in here in 2015. So, again, talk about an honest group of people around here. Although I doubt he had anything to steal in there. All right. So here we've got letters for underwriters and certain other requesting parties. We'll find out what I'm talking about there. So, for those of you in class, I'll distribute paper copies. If you'd like one, if not, just let me know. Letters for underwriters. Well, when you hear the term underwriter, which type of party do you think of? What does an underwriter do? Anybody know? Okay. You've heard an underwriter for one of two things. The more probable place you've heard of an underwriter is with insurance. For example, an insurance policy is being underwritten while they're checking out risk, etc. An underwriter of insurance does that. But what we're going to talk about here today will be underwriters of stock and bonds. So a different type of underwriter. So here with the underwriter of stock and bonds, it's somebody that bears a major risk component, very major. It is a company who is going to buy the stock or bonds directly from the company issuing them, and then will resell them to others. So kind of like an intermediate store there, if you will, if we think about retailing, kind of like a retailer of these. Buying the stock or bonds from the company originating them, then reselling them to other customers. So if we think about that, here's the price at which the underwriter pays versus the price at which the underwriter sells. Show you my board better here if you are online. All right. So the underwriter buys these securities, namely stock or bonds, from the company issuing. The underwriter buys them at one price. Let's say it's stock that they bought for $50 a share. And the underwriters bought this big block of securities, stock or bonds. Now the underwriter goes out and sells them. The underwriter promotes them, etc., just like any seller. The underwriter, of course, is hoping that these securities take off in price. The price goes way up, and it may well. For example, if the underwriter has the right initial public offering, IPO, it could really take off in price once it comes out. Well, the underwriter could make a whole lot of money. And the difference here, this profit figure, if you will, is called the underwriting spread. Of course, the underwriter is hoping the underwriting spread will be as big as possible, just like any profit. Do you think it could turn negative, though? Oh, yeah, it certainly could. So it could turn into a loss as well. So shall we say the underwriter bears a lot of risk because this underwriting spread could turn negative. Here's another reason why the underwriter bears a lot of risk. The underwriter is another specialist under the Securities Act of 1934, just like the auditor is. In other words, has some specialized knowledge, some specialized task, some specialized expertise. In this case, with buying and selling stock and bonds. Well, as the underwriter promotes the stock or bonds and sells these, do you think the underwriter could have the possibility of charges by the general public that they have misled the general public? Yes, just like any seller of anything. Yeah, it's like a car manufacturer. You sold me this car, it's got a defect. I'm suing you. Same thing with underwriters. So they bear a lot of risk, a whole lot. As a result, an underwriter may want a special letter from an auditor. And that letter is what we will talk about today. So a letter for an underwriter, commonly referred to as a comfort letter. So it gives the underwriter some comfort as far as, well, here is more information for you so that you can control your risk. Now, as a result, the CPA running this has to be very careful about what they say and what they do not say, because if they say too much, they can certainly get in trouble there. If they say too little, then the underwriter may no longer want a comfort letter in the future. CPAs want to write these, trust me, because they're profitable. So we have to walk that fine line between what we can and cannot say. Now, as far as an underwriter goes, you've certainly heard the names of underwriters. The world's biggest underwriter is a name you'll certainly recognize. Any ideas to who that may be? Give you a hint, 2 Jewish names. Okay, in the world securities, that didn't help much. Okay. Goldman Sachs. That's the world's largest underwriter. Well, a lot of other firms do have underwriting licenses as well. A lot of investing companies. An underwriting license is something issued by the SEC. So the underwriter is a licensed type of expert, shall we say. So let me just kind of sum things up here. Then I'll go to the handout and glean a few details, but I'll sum up most of the important stuff and definitely shortening the amount of material here. Excuse me. Bless you. So to write one of these, yes, we do have to be a CPA. We do have to be an auditor, but we do not have to be the issuing company's auditor. So if we have Amazon issuing another series of stock, we do not have to be Amazon's auditor. Someone else can be. It would be rather unusual for Amazon to bring us in and then have us do the underwriting letter, but that can happen. It's going to cost a whole lot more because we won't have the expertise and the familiarity with Amazon that its auditor did have. So in this comfort letter, we are going to be meeting with the underwriter and any other interested parties along the way, and I'll describe what some of those are later. We're going to find out what they want in the comfort letter. So what do you want? And we could consult with them. Oh, maybe consider this, maybe consider that. But in the end, we want the underwriter and any other interested parties, perhaps, to decide upon the final material in the comfort letter. what should be in there. So the underwriter decides what's sufficient, not the CPA. That's very important because we never want to be blamed for that. This way, if somebody said, oh, you really should have commented on blah, 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 not our fault. It's up to the underwriter. Another important thing is that this is not an audit, so it is not done under generally accepted auditing standards. So we cite in the comfort letter that this was performed under AICPA standards, not GAS, because it's not an audit. So we cite that again, we cite that. The underwriter decided upon the content on it, in it, the sufficiency of it. Another thing is that these are not required by the SEC. They're not required by the SEC, therefore these are never filed with the SEC. This also means that distribution is restricted. We don't want these going out to the general public. They are only given to the underwriter and any other named parties. It's very important to help protect the CPA and anyone else. So distribution is absolutely restricted. The information that we can give in a comfort letter follows these guidelines. We can give positive assurance on any audited information, plus anything derived carefully, or derived closely, I should say, from audited information, obviously derived carefully too. Who wrote that work up there, but either they're very tall or they, oh, I bet they stood on the stool over there. It's over in the corner if you're online. Ooh, I've stood on that stool. You think you want to? Not unless you have really, really steady legs. And now that I've been up there and I kind of question how steadily I was standing, I don't think I want to do it again. Yeah, because now if I went back up there, I'd probably, oh no, I'm going to feel like my legs are wobbly and expect that, and that wouldn't be very good because that would be a self-fulfilling prophecy. Would anybody like to stand up there? We could run a betting pool. Okay, nobody wants to risk it. I won't blame them. So again, here's what we can say. We can give positive assurance in this cover letter about audited information or anything closely derived from it. It's like financial ratios from audited financial statements, no problem. Now, for anything else, we can give negative assurance about it as long as it falls under our expertise somehow. Lights. Negative assurance about anything else within our expertise. And no assurance for anything outside our expertise. Oops. Okay. So, positive assurance, audited information, anything closely derived from it. So, in our opinion, this information is fairly stated in all material respects, usually based on the financial statements from which it's been derived. So, we give an opinion, positive assurance on this. We give negative assurance on this. Anything else which is within our expertise, but it's not that closely derived from audited financial statements. Now, if we don't know something about it, it's outside our expertise, or if we feel uncomfortable in some way, give no assurance. We don't comment. Common things about which we would not comment, of course, would involve vouching for the achievability of something, like in the company's first year of operations, the company issuing stock here, an IPO, initial public offering. We think that their forecasted net income will be within such and such a range. Don't do that. That lends the air of achievability to it. And if this company doesn't achieve that, we're going to be the blame. So don't do that. Never vouch for the achievability of something. We never give any type of legal opinion. So that's for the lawyers. We also never want to vouch for the competency of some party, the capability. For example, we would never say that we think this management team is good or bad. Never do that. One thing that, or one other party, I should say, that we often see as we talk about underwriters is someone called a broker dealer. A broker dealer is the next step down after an underwriter. The term broker dealer is a specifically licensed category with the SEC. So underwriter is specifically licensed, so is a broker dealer. A broker dealer will be the primary party buying from the underwriter, buying securities from the underwriter. So various broker dealers usually buy securities from the underwriter. They will resell these to even smaller investors, maybe some broker dealers, maybe some pension plans, maybe some other institutional investors, maybe some to the general public. But then usually the securities filter down to smaller broker dealers, and those will resell either to the general public or to individual stock traders who will resell to the general public. So there's kind of a pecking order, if you will, here, in which the securities flow down to the general public. Many banks, for example, are broker dealers because they do have investing divisions. Many banks have gotten in trouble too. Wells Fargo, very notably, several years ago, trying to push their customers into their investment division. And yes, broker dealer, so trying to sell sometimes risky securities to them. Any questions so far? All right, let me just have a look here and the handout and see if there's anything that I need filled. Oh, one other thing that I should say. If anyone other than the underwriter requests a comfort letter, sometimes they do, like a broker dealer will, they must prove why they need it. They must furnish what's called a representation letter to the CPA. So here's why we need a comfort letter. So CPA doesn't just give these to anybody. It's a major way to limit our risk. Through here. One other thing that we always mention in a comfort letter is that we are independent. So the independence of the accountant is always mentioned. So it must be independent to do these for obvious reasons. Okay. That's all I need. And with the little bit of homework, that would just be the multiple choice questions here. If you choose to do them, it's optional. You will find answers under Canvas files. If you do them, you do not need to turn them in any place, an online accounting lab or any place like that, but just do them for your own clarification if you choose to. Okay. And that should certainly cover you with any questions you may see on the CPA exam in regard to underwriters. Okay. Next thing I'd like to do is about interim financial information. If you're online, let me show you where we can pick that up. So I'm going to come here to AUC 930, interim financial information. Open this up. Again, I'll be able to cut back some of this material. So if you're here in class, I'll bring around a paper copy of the handout. If you'd like one, just let me know. Just run a couple more copies now. We'll be right back. Here we go. Okay, so here with interim financial information, what are we talking about? Well, first of all, when it comes to interim financial information, we come back here if you're online. First of all, with interim financial information, we're talking about something less than a year. So we're talking about something less than a year, usually quarterly financial information. That's the most common thing. It can be even something different. For example, Publix provides a weekly income statement to every single one of its stores. And with SAP, they have gotten so good, they said, that they can drill down to specific products. They can tell, for example, if an individual store had one too many key lime pies, they have to throw it out. So yeah, they've gotten really, really good drilling down with information through using SAP, their ERP. And so they have a lot of control, shall we say, over their stores. I'm sure some managers don't like that, but well, that's the way it is. Now, for interim financial information that is released to the general public, again, most commonly quarterly statements every 3 months. Well, with quarterly statements, we're usually talking there about financial statements that may look like annual financials, but usually in less detail. And they usually have a lot more estimates in them. Because timeliness is a big thing here. For these quarterly statements, the client can elect to have a CPA review them to do a lesser form of engagement than audit. We'll see what a review is. So the client can elect to have a CPA come in and do a review. Interim, excuse me, interim financial information. Like, excuse me. That's entirely up to the client. Some clients do it, a whole lot don't, as you can guess, because it involves additional expense. This type of engagement is much, much less in scope than an audit. It involves a whole lot less than an audit does. So, client option. As it turns out, that means the SEC does not require it. And in fact, these review reports we'll see are never filed with the SEC. That limits the CPA's risk. So, never a part of any official SEC file. So I'm going to go ahead and share my screen if you're online. Okay. So enter financial information here. Let me glean some details here. So a little introduction. This section provides guidance for conducting reviews, so not audits, but far less in scope reviews of interim financial information, as well as some reporting issues. We'll see what's in the report. And the interim financial information covered by this section may be presented alone or maybe with audited financials. It could go either way. Now, in C, the account should understand the client thoroughly understands the review procedures be applied and that those procedures are substantially less in scope than an audit. And ideally, this understanding should be documented in an engagement letter. Well, it sounds like we have a choice. I guess we do, but practically, you want the engagement letter. You want to make sure this client understands they're not getting an audit. That's important because sometimes that can be confused. Then D, the objectives of a review are substantially less in scope than an audit, as I said. A review is designed to determine whether material modifications should be made on the basis of inquiry and analytical procedures. So there are the procedures we do. We do some inquiry of the client. We do some analytical procedures. We're just seeing if big changes need to be done. So again, a lot less in scope than an audit. And the account should bear in mind that timeliness is an important element in interim reporting. And that means the interim reporting relies a lot on estimates, like I said. Well, here are the procedures for review. Again, a lot less than audit. One thing is, we're to inquire about the nature of the accounting system and significant changes in internal control. Now, usually we did the last audit. We didn't have to, but usually we did, so we pretty much already know. So we would just focus on any changes. And one selling point to a client is that, hey, if you have this review done, this can speed along next year's audit. Now, in B, we'll apply some analytical procedures to identify unusual items. Now, the following analytical procedures should be applied. We'll compare financial information with preceding periods. This must include disaggregated revenue data. So we've got to do time series comparison, also known as horizontal comparison. We must be very careful with revenue because, quite frankly, revenue drives the income statement, and most frauds involve something about revenue. So disaggregate revenue. Compare revenue month by month this year versus last year. Compare store by store this year versus last year. Compare territory by territory this year versus last year, like Central Florida versus North Florida, something like that. Number two, we'll compare financial information with anticipated results like budgeted figures. If things are too far off, we dig deeper. Third, we'll study financial information which would be expected to conform to predictable patterns, such as industry financial ratios. Things look off, find out why. Number four, we'll compare financial information with non-financial information, making sure it makes sense. So if Publix is talking about building a new building at, which they are, a new store at, I'm trying to think of the name of the plaza, I can't remember, but on Hardin, just north of the Polk Parkway, you know what I mean? Maybe not all of you go out there that way. Okay. Well, Publix is building a new store at the corner of Hardin and Polk Parkway, just north of Polk Parkway. It's the one by Target. That's not familiar. Okay. This public store is about 40 years old, maybe a little over. So they've already demolished it, from what I understand. I'm not out that way too often, I guess. But they've already demolished it and they're replacing it. So public's going through a cycle of that with their stores, with their older stores. So in their financial statements, we may see that. In fact, we would expect to see it. If we don't see something about construction costs for these new stores, they've left something out, obviously. Yeah, Publix now considers these stores to be obsolete. They want flashier new stores for the next 40 years or whatever. Yeah, really good question. What will retailing look like in 40 years? I don't know. Think people will still be going to public stores? I think, yeah. Granted, they may have more deliveries, etc. Or there could be some other players involved here in Florida as well. You think we may see physical Kroger locations by then? Maybe, or maybe Kroger will just stick to delivery. Maybe there'll be grocers that we've never heard of too. So I'm sure the playing field will be somewhat changed. But I bet Public's still around in one fashion or another. But they're trying to make sure that they build stores that appeal to the next generations of shoppers here. Because shoppers don't want to go, ooh, those public stores are so old. I don't want to go in them. I want to go in Kroger's flashier news stores instead. Now let's see. We're going to review minutes of meetings of stockholders and the board of directors because they talk about big stuff. We want to make sure those big things are in the financials. D, we'll read the interim financial information to determine the base of information coming to our attention, whether it conforms to GAAP or not. So we're just thinking, does this conform to GAAP? Again, not the level of testing is in on it. E will obtain reports of any other accountants who've reported on any segment of the client, if there are any. F will obtain some evidence that the interim financial information agrees with or reconciles to the accounting records. If it doesn't, that needs to be corrected now. So the detailed tie-in needs to be there. And then G, here are some very specific inquiries. Whether the interim financial information has been prepared in accordance with GAAP, any changes in the client's business or accounting system, any questions arising from analytical procedures, if there are any subsequent events which may have material effect, management's knowledge of fraud or suspected fraud, including any allegations. So there, we're told to inquire about those things, again, sounding pretty familiar with what we have in on it. And then, as always, want to back things up in writing. So on H, obtain representations from management about its responsibility for the financial information, the completeness of the minutes, subsequent events, and any other matters deemed necessary. Again, not unlike an audit. Not unlike an audit, I should say. There, got the lights back on. Then in Roman numeral 3, some matters affecting the review procedures be applied. Well, the extent of the procedures to be applied will be affected by the following. First of all, the accountant's knowledge of the client's accounting and reporting practices. If we did last year's audit, we have a lot of knowledge already. If not, well, we're starting up, that takes longer. Second, any significant deficiencies in the client's internal control structure, policies, and procedures. In fact, very poor internal control may prevent the accountant from performing a review of interim financial information. Well, as always, any problems with internal control mean that we've got information that's messed up. It's going to take us longer. Third, any change in the nature or volume of activity or accounting changes. So obviously, that always takes us longer. Number four, issuance of any new accounting pronouncements which apply to the client, because we've got to consider how those apply to the client. We have to make sure the client is applying those as they should, because it's new GAAP to follow. Number five, any accounting records located in multiple locations. That will take us longer. Number six, any questions raised in performing the other review procedures. That'll take us longer. Number seven, the results obtained in the client's last audit. If it's good, that means pretty good sign. We can move along this review at a pretty good pace. On the other hand, if they were bad, take us longer now with the review. Number eight, any litigation claims and assessments against the client, those will take us longer. And B, if practical, many of the review procedures can be performed at interim dates. Now balance our workload. So before the quarter end, for example. Now, with reporting, so I go over some things here with reporting. Well, first of all, the accountant may permit to use his or her name only if there's been an adequate review, just like in an audit. Must be an adequate audit before we can lend our name to it. And if the accountant's report is significantly restricted, his or her name may not be used. We have to be able to do a full-fledged review. In B, each page of the interim financial information should be marked unaudited. Make sure that we do that so that nobody thinks they are getting an audit here. Then C, the following example of a clean report is found in the SAS. Now, in other words, everything is okay. So we've reviewed the accompanying, we described the information or the statements of ABC Company and consolidated subsidiaries as of September 30th. And for the 3-month and 9-month periods ended, they sound like quarterly financial statements. These financial statements are the responsibility of the company's management. That sounds familiar. Excuse me. Then low scope paragraph. We conducted our audit in accordance with standards established by the AICPA, not GAS. We're not doing an audit. And a review of interim financial information consists principally of applying analytical procedures to financial data and making inquiries of persons responsible for financial and accounting matters. It is substantially less in scope than an audit conducted in accordance with GAS, the objective of which is the expression of an opinion regarding the financial statements taken as a whole. Accordingly, we do not express such an opinion, so we disclaim an opinion here. Based on our review, we are not aware of any material modifications that should be made to the accompanying financial statements for them to be in conformity with accounting principles generally accepted in the United States of America. So that final paragraph there is a negative assurance. We find nothing to indicate something's wrong. Just like in that letter for underwriters, the comfort letter, where if we did not have information closely derived from audited financial statements, but we felt that it's within our expertise, we could give not positive assurance, not an opinion on it, but we could give negative assurance like this on it. Nothing happened to come to our attention to show that the information was messed up. Well, then D, following circumstances can lead to modifications in the report. First of all, the reference to the report of another accountant if responsibility is shared. And second, a departure from GAAP. Reports to describe the departure and its effect on the interim financial information. Third, inadequate disclosure. Report should include an explanatory paragraph describing the information which the client should disclose. Let's hope the client instead simply includes the information when we say so. If not, we have to modify. A modification is not required due to an uncertainty, so we don't know how a contingent liability would turn out, for example, or to a lack of consistency in applying accounting principles, like client changing from LIFO to FIFO, if disclosed by the client. Then E, the reasons for any modification should be discussed with the client before issuing the report, so the conditions can be corrected. And if the conditions are corrected, then if the conditions are not corrected, uncorrected that is, then the actual modification should be made. Also, any fraud or illegal acts discovered should be discussed with the client, specifically with the audit committee. The account should also discuss other important findings with the audit committee, but the extent of the findings will not be as in-depth as in audit, just know. Then F, the accounts report should be included if the interim financial information is included in the client's SEC filing. Well, there's just a little disclaimer here. If you read on, the client must state the review report is not part of the prospectus, the filing with the SEC, that is, even though it must still accompany the financial information to which pertains. So any place these reviewed interim financials go, the review report must go along with them. If that goes into an SEC filing of some sort like Form 10-K, the client must just include a disclaimer that that review report is not a part of the official filing with the SEC. That limits our responsibility. Let's see, Roman numeral 5, don't worry about that. If you would like, you can do cases 1 and 2. Just for your own clarification, there are answers in your notes. You don't need to submit them in any place, so doing them is optional. Any questions here about interim financial information? All right, I just have one last thing to do very quickly here. Okay. Last thing I have here is something I need to go over, which is actually covered on this special reports handout. So AU-C 806. It's on the very last page of it. It's very short. And for those of you in class, if you have a copy of this, I think you all do. Starting off with special reports. Okay, it's on the very back of it. Summary financial statements. So we've got some financial statements here, which are going to be in a lot less detail than big, full-blown financials. So instead of listing, for example, all different current assets, maybe summary financial statements will just have one line item for total current assets. Just a way of summarizing things for any readers. Obviously, summary financial statements are not in enough detail to conform to GAAP. But the CPA can do a type of service with them. It's a really quick type of engagement. It's not really an audit of them. It's not really a review of them. It's just an engagement, shall we say, to make sure the summary financial statements are consistent with the full-blown financial statements from which they were derived. So the summary financial statements jibe with the full-blown financial statements. Let's see that here. Well, introduction. Well, again, summary financials are presented in considerably less detail than financials, which are in accordance with GAAP. The client may ask the auditor to report on the summary financials in order to give assurance on them. Again, it's a client option, not required by the SEC or anyone else. So as you can guess, this is not a really common form of engagement, but it's out there. Here's information about it. Maybe it will get you one question right on the CPA exam. Well, the auditor may accept this engagement only if he or she has audited the full-blown financials. By the way, he or she may not accept this engagement if he or she gave the full-blown financials disclaimer or an adverse opinion. So those two worst-case scenarios, don't even go there and pretend that you can summarize those very messed up financial statements. C, the auditor must also obtain management representations for the summary financials. Management has to say that they believe those summary financials are fairly derived from the full-blown financial statements in all material respects. So they're an accurate summary, shall we say. Well, then, reporting on these summary financials. Well, when the auditors conclude that a clean opinion on the summary financials is appropriate, the auditor's opinion should state that the summary financials are consistent in all material respects with the audited full-blown financial statements from which they've been derived, in accordance with the applied criteria, such as GAAP, usually under GAAP. So the auditor just says basically, yes, indeed, we have a fair summary of the full-blown financials here. And we're giving positive assurance about that. So it's a quick engagement. Now, the summary financials are not consistent with full-blown financials in all material respects. The auditor should ask that management correct the summary financials. If management refuses, then the auditor should express an adverse opinion on the summary financials. Hope we never have to get into that. You know, it doesn't make sense for a client to have us come out to do this optional engagement, and then they refuse to correct the summary financials. That'd be stupid. And C, the summary financials should be read in conjunction with full-blown financials. We make that warning. If a reader chooses not to do that, that responsibility is now upon them. That takes care of our very last one. Questions on it? By the way, with the review that we saw today, we'll see a very similar type of review when we go into the graduate level auditing class. And if you do go into MAC programs, I hope you will. You know, a lot of you are already in it. Well, in the very first class, in fact, in the graduate level auditing class, I go through reviews and compilations, which are for annual financial statements of non-publicly traded companies. They may not have an audit. I mean, they may want an audit, but they may elect to have a review. It's a lot less in scope. It's cheaper. Or simply compilation, simply write-up work, a whole lot cheaper. So we'll see what those are at that time. All right. So what we'll do on Wednesday is not cover new material. I'll be here to answer any questions. I will finalize the exam by then, and it will be online. I will send you instructions for that. And what questions can you think of right now? Anything? No? Okay. So have a good one, and I will see you back on Wednesday. Oh, I'm sorry, Jack. Tonight. Yeah. So I'll get the instructions, including those essays up tonight. Okay? You betcha. Have a good one. Bye-bye. Boris.
Is that still due on Wednesday? Exam 3 multiple choice?
Oh, exam 3 multiple choice, not due this Wednesday. I'm sorry. Okay, good question. So exam 3 multiple choice, no, not due this Wednesday. I had that a week early.
Are you gonna find no response? I think it's still like something.
Yes, I didn't grade yours.
No, mine is-
Oops, I
mine-
must have skipped yours.
mine is not in the-
I will go back and grade it. I'm sorry,
Oh, it's
Boris. Okay,
Yeah.
I'm sure you did perfectly. Take care as well. Mhm. No,